Welcome. In this video, let's compare marginal and absorption costing. Let's begin with a look at marginal costing. Let's imagine that I have a kiosk and I sell bottles of iced tea for $1. Let me show you the cost structure of my business. The variable cost to make and bottle one portion of iced tea is 45 cents. Those are my raw materials and the bottle. All of the costs associated with producing one more unit. And then I have my fixed costs, the rent of my kiosk, and that is $75 per month. Let's keep it simple with these two costs. We've got a variable cost and a fixed cost. Under marginal costing, this is how I think about my costs and my revenue at the unit level. When I sell one bottle of iced tea, I earn the $1. However, to produce and sell that bottle of iced tea, I had to spend 45 cents. The difference between the price and the variable cost is a very important number to me. That number is called contribution, and that's 55 cents. Contribution, that means giving to. That is the contribution to my fixed costs and my profit. Understanding my contribution per unit is very important for my decision making. For example, I can understand my break-even point with this information. My fixed costs are $75. I would like to know how many bottles of iced tea I need to break even, to cover all of my costs, so I'm not at profit, I'm not at loss. And all I have to do is divide the fixed costs by the contribution per unit, and that will tell me my break-even point. I'll abbreviate that like this, in units. And that comes to 136.4, or rounding up to 137, because we cannot sell a partial bottle of iced tea. That is marginal costing in a nutshell. Under marginal costing, when I'm thinking about my financial performance over a period of time, I'll do that with a P&L statement, a profit and loss statement. So let me show you how. And it will look like this. The top line of my P&L will be sales. And I will subtract my total variable cost from that, production and non-production. If I have to pay a commission to a salesperson for selling every bottle, that would be in my total variable costs as well. The difference between those two lines would then be my total contribution. My fixed costs I consider as a period cost, for example, my monthly rent. And that will not change on business activity. Those costs are fixed. If I sell one bottle or 100 bottles, the rent is the rent. The difference will be my profit. That's marginal costing in a nutshell. Let's now compare marginal costing with absorption costing. And to do that, let's look at my imaginary friend's business. Let's call my imaginary friend Bob. Bob has a business manufacturing mountain bikes. And he has a factory that he rents. His rent is $100 per month. Bob's plan is to sell 10 bicycles per month. He knows his selling price, which is $35. He knows his variable cost, which is $20. And he also knows his contribution per unit, which is $15. Now, Bob is thinking about dropping his selling price to boost demand, and he's thinking about dropping his price to $25. And he's okay with that because he still has positive contribution. And he says to himself, as long as I have contribution, I am chipping away at my fixed costs, and eventually I'll be in profit. But you probably see that this is a very dangerous idea, because if his demand turns out to be inelastic and he doesn't sell more bicycles, if he sells 10 bicycles, he'll only earn $50 in contribution. $50 will not cover his rent, and Bob will go out of business. This problem is what brings us to absorption costing. Under absorption costing, we want to think about the cost per unit, not only with our variable cost, but we want to think about it in terms of full cost. And to do that, we are going to assign part of the fixed production overheads to the cost units. We said we had a plan here. So the mechanism that we use to achieve this is called an overhead absorption rate. And that is abbreviated in our books as OAR. The way we'll do that is we will take our budgeted, B for budgeted overheads, and we will divide those by an activity. In this case, we're only selling one product, so we could do that by the unit. And if we do the math, we see that our fixed cost, our rent, is $100. Our plan is 10 bikes, so that gives us an overhead absorption rate of $10 per unit. So the variable cost per unit is $20, and the fixed overheads per unit are $10, so now we have a full cost per unit of $30. This number, understanding the full cost per unit, helps me with my long-term planning. Next month, when I produce and sell 10 bicycles, how much is it going to cost me per unit? Because I need to recover the variable cost and the fixed cost. If I'm making a short-term decision and I want to understand how much does it cost to produce one more bicycle, then I can work with the variable cost per unit. If we compare an absorption costing P&L to our marginal costing P&L, and we can abbreviate that AC, the top line is the same, our sales. However, the next line will be our full production cost. That will be fixed and variable costs because we are assigning our fixed production costs to the units that we produce and sell. The difference between those lines would be called gross profit. And this helps us understand the performance of our products. Are we selling our products for more than it costs us to produce them? And from the gross profit, we'll then subtract the non-production costs, our administration costs, our selling costs, our distribution costs. And the difference between these two lines would be our net or operating profit. And this tells us if the business is earning more revenue than it costs to run the business. Friends, that's marginal costing versus absorption costing in a nutshell.